$13.06 billion in revenue, a 20% surge in AI business. Intel's latest earnings report feels like a hard slap in the face to the bears, but behind that polished non-GAAP mask, a massive 73-cent loss per share still sits there like a deep, open wound. Is this the comeback of a chip giant or just a brief flash before fading out during a painful transformation? As the stock surged 15% after hours and then quickly pulled back, Wall Street is facing one of its toughest calls yet. What's up, guys? Welcome back to Deep Dive Stock Earnings. This latest report from Intel perfectly captures what divided really looks like. On one hand, it crushed expectations and showed the strength of a legacy giant. But on the other hand, those brutal losses are a reminder of just how painful this transformation really is. Intel reported $13.06 billion in Q1 revenue, up 7% year over year, along with non-GAAP EPS of 29 cents. Both key metrics came in above Wall Street's relatively pessimistic expectations. That tells us something important. Intel's core business is showing more resilience than the market feared. In a volatile semiconductor cycle like this, putting up numbers like these at least stabilizes sentiment. You've got to understand beating expectations is the catalyst for any rebound in U.S. stocks. Intel did exactly that. It sent a signal to the market. Yes, I'm going through a tough transition, but my core is still intact. That kind of performance suggests operational efficiency is improving. But if we look at strict GAAP numbers, the reality is very different. Intel posted a loss of 73 cents per share this quarter, reflecting deep ongoing net losses. The reason is straightforward and brutal. Massive restructuring costs, heavy depreciation from new fabs, and extremely high R&D spending tied to its transformation strategy. This loss makes one thing clear: the road to profitability is going to be long and expensive. A 73 cents per share loss means one thing: you're still bleeding heavily. Intel's strategy right now is aggressive. It's sacrificing current profitability to bet on future technological leadership. That kind of model demands serious patience from investors. If you can't handle short-term pain, Intel might not be for you. The data center and AI segment is the brightest spot in this report. Revenue reached $5.01 billion, up 22% year over year. This growth is largely driven by strong demand for the new Xeon 6 processors. Amid the AI infrastructure boom for a company that's been criticized for falling behind in AI, this is a powerful response. It proves Intel still holds significant influence in the server market. That 22% growth is Intel saying loud and clear, we're not out of this fight. Everyone thinks AI equals NVIDIA, but don't forget AI servers still need general compute and orchestration. That's Intel's home turf. The success of Xeon 6 shows that if the product cycle is right, big customers will still buy. The foundry business is at the heart of CEO Pat Gelsinger's turnaround strategy. This quarter, it grew 16% to $5.04 billion in revenue, offering early signs that Intel is building a real manufacturing ecosystem. While foundry is capital intensive and takes years to pay off, the current growth suggests this is no longer just a vision, it's becoming a real business. The foundry segment is both Intel's most undervalued asset and its biggest risk. It's the company's second growth curve right now. A lot of the work is internal, but 16% growth shows external demand is starting to build. If you believe the world needs an alternative to TSMC, then Intel Foundry is basically the only option. What really drove the after-hours volatility was Intel's strong Q2 guidance. The company expects revenue between $13.08 billion and $14.08 billion, with the midpoint well above Wall Street consensus. This suggests that growth in AI and foundry is not a one-time spike. It could actually accelerate in the coming quarters. That kind of forward confidence significantly boosts market sentiment around the turnaround story. In the U.S. market, guidance matters more than current earnings. The fact that Intel is willing to give such an aggressive outlook means they likely have strong order visibility. This tells the market one thing: the worst might be behind them. That's why the stock initially surged after hours. Market reactions to this report have been sharply divided. Bulls are focused on the explosive growth in AI and foundry, believing the turnaround is working. Bears, on the other hand, are locked onto the ongoing losses, massive spending, and weak performance in the legacy PC segment. This divergence led to extreme volatility, up 15% after hours, then pulling back sharply. This isn't just a data debate, it's a clash of investment beliefs. Both sides have valid arguments. The weakness in PC is a real concern, But AI opens up massive upside potential. Intel right now is a company running while wounded. Its stock price is being driven by the market's belief in its probability of a successful comeback. So what do you think? Can Intel reclaim leadership through AI and foundry? Drop your thoughts in the comments. This is Deep Dive Stock Earnings. I'll see you in the next one.